In the world of finance, understanding credit risk is crucial for managing borrower defaults. Today, we delve into the key components of credit risk modeling: probability of default, loss given default, and exposure at default. These components help institutions assess lending risks and form effective strategies to mitigate them. Let's start with the first component, probability of default, commonly known as PD. PD indicates the likelihood that a borrower will default on a loan within a specified period, usually 1 year. It's calculated using various factors including credit scores, payment history, and financial stability. Financial institutions leverage statistical models like logistic regression or machine learning for PD estimation. A higher PD signifies greater risk that a borrower may fail to repay their loan. For instance, someone with poor credit might have a high PD, indicating higher default risk. Conversely, a borrower with a solid credit score tends to exhibit a lower PD and hence lesser risk. Moving on to our second key component, loss given default, abbreviated as LGD. LGD measures the potential loss a lender would face if a borrower defaults on their loan. In simpler terms, it's the percentage of the loan amount that is unrecoverable post-default. Factors influencing LGD include loan collateral, asset value, and recovery processes in place. For example, in case of mortgage defaults, selling the property may recover some costs for lenders. If property values drop or recovery is slow, the LGD can be significantly higher. On the other hand, more liquid collateral or efficient processes can lead to lower LGD values. Finally, let's discuss exposure at default, abbreviated as EAD. EAD represents the total value lenders are exposed to at the moment of default occurrence. It considers the outstanding balance of loans and any undrawn amounts on credit lines at default time. For example, if a borrower has an unused credit line during default, EAD includes this total amount. Understanding EAD helps lenders grasp their complete exposure to risk and manage reserves appropriately. Now that we've covered PD, LGD, and EAD individually, how do they fit together? Together, these metrics form the backbone of credit risk modeling for financial institutions. They allow lenders to estimate potential losses from lending and make informed decisions about borrowers. By grasping these elements, financial institutions can craft better lending strategies and terms. To summarize, PD assesses default likelihood, LGD gauges loss magnitude upon default, EAD quantifies exposure risk. Understanding these components is vital for building robust credit risk models ensuring financial stability. Ultimately, mastering these concepts allows lenders to maintain profitability while reducing associated risks. Thank you for exploring the essentials of credit risk modeling with us today.